Welcome to Dividend and Conquer, your go-to channel for navigating the complexities of the stock market. Today, we're delving into a topic that resonates with every investor's journey: the allure and pitfalls of certain dividend stocks. Imagine you're embarking on a long journey through the stock market. It's a path filled with twists and turns. Every investor, including the savviest ones, has faced situations where choices didn't pan out as expected. Missteps are a part of the journey, but what if you could sidestep a few? Let's zero in on 3 dividend stocks that, at first glance, seem promising but often lead to regret. The stock market is not just about numbers and charts. It's about understanding the story behind each stock, its potentials, and its pitfalls. A primary red flag in investment is a lack of understanding. When it becomes challenging to comprehend the workings of a company, it is often wise to reconsider. Investing in something that is not well understood can be risky. This is exemplified by individuals who have invested in companies like CRISPR Therapeutics or Beyond Meat, often relying more on luck than strategy. Investments in such companies can sometimes resemble a roller coaster with significant highs and lows. This approach is more akin to gambling than investing. Seasoned investors, on the other hand, strive for well-calculated risks rather than mere gambles. It's crucial to invest within your realm of understanding, a principle emphasized by investment gurus Warren Buffett and Charlie Munger. Beyond the numbers, you should be asking, how does the company earn its keep? What sets it apart from its competitors? And most importantly, do you believe in its long-term potential? If these answers elude you, it might be time to file that stock under too complex. Now, let's talk about value traps. These stocks disguise themselves as bargains, but are often mired in underlying issues that are detrimental to growth. A prime example might be a company like Walgreens Boots Alliance. On paper, it looks attractive with its plummeting stock prices and appealing valuation metrics. However, a closer look reveals a different story: declining profitability, increasing debt, and dwindling cash flow. It's a classic case of a value trap, a stock that's cheap for a reason and not in a good way. Another trap to be wary of is the yield trap, characterized by stocks or ETFs offering sky-high dividend yields. While they may look enticing, they often struggle to sustain their dividend payments. Companies like Orchid Island Capital and Zim are classic examples. High yields can be like margaritas, enjoyable in moderation, but disastrous in excess. A sustainable and moderate dividend yield is often a more prudent choice than an eye-poppingly high one. I want to ask you, have you ever encountered a value trap or a yield trap in your investment journey? Share your experiences in the comments below. But our journey doesn't end here. Let's explore further into the world of dividend investing, a realm filled with both opportunities and pitfalls. When considering dividend stocks, it's essential to understand the company's dividend history and policy. A consistent and steadily growing dividend can be a sign of a company's health and stability. Take, for example, Johnson & Johnson, a company that has increased its dividend for 58 consecutive years. This kind of track record speaks volumes about the company's financial health and commitment to shareholders. However, not all high dividend stocks are created equal. It's vital to look beyond the yield. A high yield might seem attractive, but it's crucial to assess the sustainability of these dividends. For instance, a company with a high dividend yield but stagnant or declining revenue could be a red flag. It suggests that the company might not be able to sustain its dividend payments in the long run. Let's analyze a real-world scenario. Consider the case of IBM, a company once revered in the tech industry. Over the years, IBM has maintained a high dividend yield. However, the company's revenues have been on a steady decline for several years. This raises a crucial question: how long can IBM sustain its high dividends if its core business continues to shrink? Another critical aspect to consider is the payout ratio, the proportion of earnings a company pays to its shareholders in the form of dividends. A payout ratio that is too high, say over 80%, can be unsustainable in the long term. It might indicate that the company is not reinvesting enough back into the business, which could hinder future growth. Now, let's shift our focus to sector analysis. Different sectors have varying typical dividend yields. Utilities, consumer staples, and real estate investment trusts, REITs, are known for higher yields, owing to their stable and predictable cash flows. However, technology and healthcare sectors typically offer lower yields, as these companies often reinvest their profits into research and development. Understanding sector dynamics is crucial when building a dividend portfolio. For instance, investing heavily in high-yield sectors like utilities might seem a safe bet, but it can also lead to a lack of diversification. A well-balanced dividend portfolio should include a mix of sectors, aligning with your risk tolerance and investment goals. Moreover, it's important to consider the tax implications of dividend investing. In many jurisdictions, dividends are taxed differently than other forms of income. For instance, in the United States, qualified dividends are taxed at a lower rate compared to ordinary income. Being aware of these nuances can help you make more informed decisions and optimize your investment strategy for after-tax returns. Let's also talk about dividend reinvestment plans, DRIPs. DRIPs allow investors to reinvest their dividends to purchase additional shares of the company, often at a discounted price and without brokerage fees. This can be a powerful tool for compounding your investment over time. For long-term investors, the impact of DRIPs can be significant, turning small initial investments into substantial holdings. Now let's reflect on the importance of due diligence. Before investing in any dividend stock, research thoroughly. Read the company's annual reports, analyze its financial statements, and understand its business model. Keep abreast of industry trends and how they might impact the company. Remember, investing in dividend stocks is not just about chasing high yields. It's about finding the right balance between yield, growth potential, and stability. A well-chosen dividend stock can be a valuable addition to your portfolio, providing a steady stream of income and the potential for capital appreciation. Dividend investing is a journey, one that requires patience, research, and a strategic approach. Now, we'd love to hear from you. What's been your experience with dividend stocks? Have you encountered any challenges or successes you'd like to share? Drop a comment below. Thank you for watching. If you found this video valuable, please give it a thumbs up and subscribe to our channel for a regular dose of insightful investing content. Until next time, happy investing. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions.